The economic recovery continues here and around the world, but with the same risks and complications as the last few months. Our updated forecasts halfway through 2021. Despite the recent snap lockdowns in a range of locations including Sydney and Brisbane, and disjointed at best progress on the vaccine rollout, the Australian economy has continued to respond with remarkable strength to stimulus measures. It's a great relief to continue to see the aggregate numbers much stronger than pre-pandemic levels, despite the unevenness of the recovery, with fresh record highs in the latest data set for property prices and housing finance, for business conditions, a record trade surplus in May, and for aggregate job numbers. As the chart shows, our total employment is well ahead of the previous peak in early 2020, unlike most other countries who are still trying to recover all the jobs lost through the pandemic. Jobs growth has certainly been uneven here by industry, but importantly, each Australian state and territory is ahead of pre-pandemic levels of employment, and record highs for job vacancies suggests that this trend will continue, with 27% of employers reporting difficulties in finding staff in June. All of this progress has encouraged the Reserve Bank to announce a tapering in policy support, with quantitative easing pared back to $4 billion per week from September, and a concession that RBA rate hikes are now more likely to be earlier than previously stated. As we flagged in our April and May updates, the timing of an initial interest rate hike in early 2023 would be consistent with the economic progress and extent of fiscal support. And since then, November 2022 has also become a plausible candidate given the context of rising inflationary risks and tightening labour markets. So, the main factors in official interest rates will be inflation, wages growth, and how quickly we reach full employment. Also, while the RBA don't consider the property boom to be central to monetary policy, they have noted the scale of price rises and the strong demand for housing credit, with investor lending up 13% in the month of May alone. Regional property prices rose over 17% last financial year, matching the outperformance of regional Australia for employment, another example of the unevenness of the recovery. From here, we still expect property to perform strongly, given RBA rate hikes are more than a year away. But the pace of price increases should level off, especially with the fall in population and net migration growth. And that's where the same familiar risks come back into view. When will our vaccination rates allow greater mobility and the reopening of international borders? And ahead of that, how large will the fall in consumer confidence be from the ongoing snap lockdowns? The Aussie dollar has been well correlated to consumer sentiment, and so the latest dip in our dollar does make sense, especially given the recent surge in the value of the US dollar. But assuming the lockdowns can be contained and vaccination rates pick up as supply increases, then the Aussie dollar should return to following commodity prices higher. And finally, stock markets remain near record highs here and overseas, still focused on a strong recovery through this financial year and beyond. But while this new fiscal year will have the same levels of policy support, the closer we get to RBA rate hikes, the more volatile the markets may become. And that's the market update from Leveraged.